Now what is this next aspect, which is about strike price? So now, like I told you, strike price is the price at which you want to peg. Like in a lottery ticket, you have various numbers, which number you want to pick up, something like that, right? So now, let's say for some script, any script, the current market price of the underlying, which is equity shares, equity is 350 rupees. Now, these are the various strikes from 350, 360, 370, 380, 390, and it can go as much on top and below 340, whatever. Now, the difference, 350 to 360, the difference is called as spread. That is also decided by the exchange based on the contract value. Some cases the difference will be 2 rupees, some cases difference will be 5 rupees, some cases difference will be 10 rupees, some cases difference will be 50 rupees, some cases difference will be 100 rupees based on the quantity, based on the value of this underlying stock. That's how they kind of decided. In this example, I've just taken an arbitrary illustrative example. In that, I'm giving 10 rupees difference. Now, if this is the strike prices, the strike price which is equivalent to the current market price is, then we have calls. For call, the strike price which is equivalent to the current market price is called as ATM strike price. Now, ATM stands for at the money, ATM strike price. Just remember these terminologies. Current market price is 350 and the strike price 350 is called as ATM. Now, all the prices for a call above 350, above the current market price is called as OTM, which means out of the money, which is out of the money. 350 and above. 350 is ATM, 360 and above is all out of the money. Why? Because current market is 350 still, and the current market price of the underlying is still not reached. So it is far away, outside. That's why it's called as out. It's still not realized it. And then any price below that, from 340 and below, is called as in the money, ITM, in the money. Why? Because the price has risen from that level and it is realized all of that, and it is much more than that. That's why it's called as in the money. Now, similarly, for a put, 350 again is called as the ATM, and all the prices from 350 and below, they are called as OTM. Why? Because for a buyer of the put, he wants the price to go down. Now price is at 350. It has not gone down till to 340, 330, 320. So it is still outside because it wants it to go down. That is why they are out of the money, and the price from 360 and above, from where it has fallen down, they are in the money. So it's exactly opposite to call is put, and opposite of put is call. So if you kind of understand this, just kind of understand this concept, go through it once again if you want to, a concept of at the money, in the money, and out of the money. These are the three concepts which you have to understand. If you understand this and strike prices, it's pretty simple. Balance everything is pretty simple to kind of trade in options, as simple as that. Now, I want to discuss one more sub concept here of how the options premium and how do you get the value, and once you buy something, when will you realize that and all of that, right? So I will do a calculation. I'll kind of show that to you so that you kind of get that theoretical understanding so that it becomes easier. That I'll see you in the next video. See you in my next video on that options calculation. Bye-bye.